I do want to talk about where we are in this stock market. We're at intraday records on the S&P 500. You have the likes of Goldman saying that maybe there's another 4% to go through year end. What's the JPMorgan Asset Management view?
So to us, the fundamentals look pretty strong. That's the good news. So our analysts think earnings next year in the US grow by around 13%. That's a pretty good outcome. That's actually an acceleration from this year. And when we listen to those third quarter earnings reports, there's plenty of strength in this economy. We've got a boom in data centers, electrification. There's a ton of government programs going on. The consumer overall looks in pretty good shape. There's some softer spots, but overall looking in really good shape. So the momentum we've got going into next year looks terrific for us. The question, of course, is where to invest. Because with the S&P hitting record highs, we're now north of 22 times forward earnings. That's a level we've only really exceeded in history, at the end of the 1990s. So those fundamentals are really going to matter. And picking your spots in terms of valuation, I think, is super important right now.
So, I mean, if I were going to invest at this point, I would just buy an S&P 500 tracker and call it a day. Maybe an ETF, but the point is, does anything outperform the benchmark U.S. stock index?
I think we can do better than that. So, yes, I think from here, the broadening out, I think, is going to be the big theme. You've heard a lot of talk about it. You've seen signs of it in recent weeks. And we think it's on. So most importantly, fundamentally. So look, the Magnificent Seven have that name for a reason. They have been absolutely exceptional companies. This year, you've got 30+% earnings growth from those companies, the rest of the market at 4%. Of course, they've outperformed. But as we look into next year, that gap starts to narrow. The Mag 7 starts to slow down, partly as they just get bigger, partly as they're weighed down a little bit by all of this investment in AI, and we'll see how that turns out. We're optimistic, but we need to see how that really plays out. Meanwhile, the rest of the market's kind of picking up. So that gap next year narrows from over 30% to somewhere in the low teens. So you've got fundamentals on your side in terms of broadening out. And then the valuations, of course, there are high prices everywhere, but the valuations for mid cap, small cap, for the value side of the equation, they're all significantly less extended than we see in large cap growth. And I'd even say, don't forget about international.
Well, Matt and I try to very hard, actually. We had a whole discussion on Friday about how if you take a look at the U.S. stock market, it just beats everything over almost every time frame. So what's going to be different this time around when it comes to international? Why should we look?
So you're right. Fundamentally, the U.S. has been far superior. If you look at the last 15 years, U.S. has beaten Europe by about 7 percentage points a year. That's an enormous margin when you compound it over a 15-year period. About 4 percentage points of that comes from superior earnings growth. So that's a lot, but it's not all of it. The rest of it has come from U.S. stocks getting a higher and higher rating versus Europe, and they probably deserve a much higher rating. But at this point, that gap in valuations is now around 40%. We've never seen anything like it. So sentiment in Europe is terrible. It was bad anyway. I think Europeans have taken the election as another challenge that they have to deal with. We've obviously got geopolitical tensions right on the doorstep. There are all kinds of things to worry about.